Greetings, Algo artisans. Yo, nice country. Be ashamed if something would have happened to it. Is war coming? Watch this before you trade oil or bonds. We're going to take a look at the United States dollar, US bonds, oil, and we're going to take a look at conflicts around the world, see how that might all be related. We're going to talk about it right now. Before we do, please like, subscribe, hit that notification bell on YouTube, and if you're following this on X, please go ahead, like, and follow. That helps us get more content out. Okay, so there's an interesting tweet that was thrown my way from Expound the Profound, cutting through BS one layer, and then the title of this person's name is much longer than that. Interesting person here, rational irrationalist, rabid dog negotiator, destructive peacekeeper, imperialist, nationalist, sapio something, pandemics are fun, war is funner, let's do both, atheist. I think there's a lot of taking the piss in that one, a lot of fun making. But let's take a look at what this person has to say. I'm going to assume the person is a him. It says, tinfoil hat time. U.S. bonds get bought because foreign CB central banks need cheap oil. Oil is priced in dollars. When U.S. bonds are bought, USD gets weaker. U.S. needs its bonds bought. U.S. stirs up trouble to cause oil to explode higher. E, go to A, which takes us back to U.S. bonds get bought because foreign central banks need cheap oil. Okay, so a couple of things to deconstruct for people who might be new to U.S. dollar reserve currency, oil, and those kind of dynamics. Around the world, the United States dollar is still the world's reserve currency. And what does that mean? Well, as of Bretton Woods, the United States dollar was essentially made the world's reserve currency. That means that everybody holds dollars because international trade is conducted mostly in dollars. Now, international trade is conducted in dollars for a number of reasons. One of them is that it's just fungible. It's a humongous financial economy in the U.S. It used to be, and still is, but really used to be a large manufacturing economy, but still a lot of finance going on. So there's enough dollars to go around where all the economies in the world can use them to purchase things. And that way everybody can purchase on the same system. There are some issues that go along with using the dollar that we have seen recently. The United States can use the dollar as what I think is its primary weapon in international hegemony, if you will, war, things like that. I think using the dollar is more effective than war because it's caused a lot of problems for nations in the past that don't agree with the U.S. They go under sanctions, and then you have economic warfare, and then you have hyperinflation. Turkey, Iran, Venezuela, Argentina, places like that have all experienced such things at the behest of those who run the United States dollar. And let's remember that the Federal Reserve is not federal. It's about as federal as Federal Express. It is a group of foreign and domestic banks, and no one really knows who it is. It's kind of a secret, although we do have some pretty good ideas and some proof as to who it might be. But long story short, the Federal Reserve is questionable as to whether or not it has the United States at its best interests, right? I think the Federal Reserve has the Federal Reserve's best interest at heart, and if that happens to align with the U.S., then that's great. So let's go ahead and talk about this business of U.S. bonds get bought because foreign central banks need cheap oil. Well, back in 1971, Richard Nixon took us off of the gold standard. So when the United States dollar was made the reserve currency, it was set up such that you could not print more dollars than could be backed by gold, and gold was all set at $35 an ounce. So that situation at hand, then the dollar was to remain stable. There wouldn't be any printing of extra dollars. You couldn't just print dollars out of thin air. It was a way of keeping the United States honest. However, there began some questions, right? Theory is that this printing the dollars out of thin air, printing unbacked dollars may have happened way earlier than 1971 when Nixon took us off the standard. But in the end, what happened was in Vietnam, the French left, and there are many reasons why people think the French left. I think perhaps it just became too expensive for them and the United States went in, and there are many conversations about that. I'm not going to really dive too far into that, but let's just say that the United States going into Vietnam and sustaining a war there, an undeclared war by the way, was very expensive. And so the French kind of figured out how much we were probably printing that was unbacked, right? And so the French wanted to go ahead and instead of being paid for their goods in dollars, they wanted to be paid for their goods in gold because they felt that they were being cheated, right? They saw what was happening with the dollar devaluation. They knew, because they'd already been to Vietnam, they probably already knew what it cost to be in Vietnam and understood that the only way we could possibly afford it was by printing dollars. And by the way, the French, maybe it was a little bit later, but the French have some of the best, we'll say industrial espionage in the world. So the French probably had an idea of what was actually going on financially, and French and then Germany actually both wanted their money. They wanted their gold, not their dollars. And And right about that time, Nixon came on TV in the middle of some special, I forget what it was, and he says, we're not going to redeem in gold anymore. And pandemonium ensued financially. And after another few years, Henry Kissinger went over to the Middle East and talked to Saudi Arabia as the de facto leader of Middle East oil production and control. And they made a deal to where the petrodollar was created, in that all of the major nations selling oil will only sell it in dollars. So then we have the petrodollar. And this is why the strength of the dollar is related to oil, vice versa, right? So in this scenario, it says U.S. bonds get bought because foreign central banks need cheap oil. It's cheaper to deal in oil when you're using dollars to purchase it. When you're going outside of the dollar, you actually end up with a lot of problems. There's a couple of countries, a number of them actually, that started to deal outside of the dollar. I'll start to name them. Iraq in the early 2000s, I think they wanted to sell their oil in the euros, and that didn't last too long. Something happened in 2003 that pretty much put a stop to that. Libya, when Muammar Gaddafi wanted to create the gold dinar and let the oil be sold in whichever currency they wanted, well, that got handled in Libya pretty quick too. There was some pretty rough stuff that happened there not that long ago. What's another country? I think Iran is definitely one of those countries, and that's been under attack for a long time economically. And yeah, I know none of these countries all have clean hands. Iran has its issues. And there's are a few other examples. I know Venezuela, I don't think we've invaded them, but Venezuela definitely produces a lot of oil, and their hyperinflation has been the result of economic warfare. The list goes on. So, it becomes expensive from a number of standpoints to buy oil in other than dollars. You have to create, if you're a country that is able to withstand those kind of economic and or military attacks, then it also is expensive to deal in oil outside of the dollar because of all of the ways you have to do it, all the things they have to set up to make it work. Okay, so B, oil is priced in dollars. When the US bonds are bought, the USD gets weaker. Now that might seem counterintuitive, right? Why would it be that when you buy something, then the dollar gets weaker? Like you buy US bonds, how does the dollar get weaker? Well, it's because it's based on yields. Okay, so now inside of this tweet thread, we have a really good explanation for that coming from Glutton, which is Andy Kim 00318-169, and he says it here. Simple explanation. Bond price has an inverse correlation of yields. What does that mean? That means when bond prices go up, yields go down. And when yields go down, your foreign exchange weakens, your dollar gets weakened. So when you buy bonds, the demand for bonds goes up. And when the demand for bonds goes up, the price of bonds goes up. And when the price of bonds go up, the yield goes down, which weakens the dollar. And then, of course, the inverse is also true. And then he goes on to talk about Japan. And we're going to revisit Japan in a moment because this is like super, super interesting. V the Gorilla over at Algo Factory, he gave us a really good explanation of what's going on with Japan and their carry trade. So they're carrying this trade to invest in the equity market. We're going to get into that towards the end because it is relevant, but it's kind of a sidebar. So let's roll back to what's going on with the rest of this original tweet. C, the US needs its bonds bought. Yes, well, essentially the 10x bond is the major bond that is pretty much the money that the world uses, right? So if there's no demand for bonds, then a lot of these bonds are going to get sold, and they'll get sold back to the United States for redemption. And when that happens, we have a problem. It means that we start to see a lot of money come back on American shores, and if that happens, you're going to have an inflation problem. So in order for the bonds to need to be bought, well, think about this. If oil is traded in dollars as the most cost-effective way to buy oil, then the more expensive oil is, the more dollars are needed, right? Because everybody needs oil. So if you can push the price of oil upward, then people will need to buy those bonds so that they can have dollars with which to buy the oil. It's a way to spur demand for oil. Now, how does somebody raise the price of oil? Well, it says here, U.S. stirs up trouble. Think about it this way. If you can disrupt oil, if you can disrupt the flow of oil, it's kind of like on Dune, right? If you ever read the book Dune by Frank Herbert, one of my favorite books, the spice. The quote is actually, he who has the ability to destroy a thing can control a thing. So if you stir up trouble around oil, which is something that everybody needs, the demand, or I should say the price of oil goes up because the supply of oil goes down and therefore the demand of oil goes up, right? If you stop some nations from producing oil, then there's less oil on the market and there's a lot more people chasing that oil, so people are willing to outbid each other. It's very, very simple supply and demand. And of course, when oil price goes higher, US bonds get bought because foreign central banks need cheap oil. So this is an interesting idea, and I love the Rodney Dangerfield meme here. It's like, oh, how does all this work? Well, we talked a little bit about it. We'll move forward into some more explanation of this, right? So an individual asks, so you're saying, this is Nameless20Z on X, says, so you're saying that there's an international devaluation of USD? Am I following correctly? Or an intentional, sorry, forgive me, let's reread that. So you're saying there's an intentional devaluation of USD? Am I following correctly? If the US destabilizes the world, global geopolitical conflict, oil rises. Since the US is such a huge exporter of oil now, price of oil goes up. Defeat that as a foreign central bank by loading up on US debt to weaken the dollar and get cheap oil. You see how that works? So if you buy a bunch of US debt, you're pushing the demand up on those US bonds. And when the demand goes up, the yields go down. And when the yields go down, the dollar gets weak. That's how that works. Okay. Now, what's one way to combat that issue? It's hiking interest rates, right? If you push interest rates up, the dollar gets stronger. Might explain to some degree why we're seeing the interest rates head up, because something's got to give, right? Now, when the interest rates go up, what does that do? It kills business. And we have done a lot of other shows that talk about this, but in the pandemic, when the pandemic hit 2020, a lot of banks were shored up with what became basically zero rate bonds, right? And when you get zero rate bonds, sure, they're all going to mature at the same face value, but in order to have your business collateralized by bonds, you need to be able to sell those bonds in case you need money, right? If you have some bonds sitting in a vault that you can't sell for 20 years, they're not really worth anything for 20 years. But if you can sell them on what's called the secondary market, if you can sell them to whoever, then they have value. What happened was as the rates went up over the past couple of years, the new bonds that came out with the higher rates, with the better yield, those actually began to be worth more on the secondary market than all those bonds that were given to all these companies and all these banks during the pandemic. And because they were worth more, those new bonds on the market with that higher value actually pushed the value down on all those bonds that were collateralizing these businesses since 2020. And when your collateral shrinks, your company becomes illiquid and thereby insolvent, right? So this was a nasty, nasty thing that happened. So hiking the rates is essentially the result of, having your debt values being pushed down. And it could be, and I'm only speculating here, but foreign central banks can load up on US debt to push the demand for that debt up, but it weakens the dollar. So what do? You just hike the rates. But when you hike the rates, you kill a lot of businesses. So the machine that makes the US work starts to also fall apart. And it actually kills the very banking system that they need to keep in place for this all to work. So it's really a nasty, nasty circle. Let's go ahead and take a look at the relationship between the TLT, and we'll also go ahead and overlay the price of, what did I overlay this? This is what? Let's see. USDJPY. We're going to go back to this talk about the USDJPY, right? So let's roll over here to, we talked about bond price up, yield down, making the dollar weak. Japan is an interesting case. They weakened their currency according to this, what is this, Glutton? They weakened their currency so much because the real yields on their bonds are negative, right? They're carrying this trade to invest in the equity market, in their own equity market, and also in foreign equity markets, I imagine. My understanding is the Nikkei is owned like 60% by the Japanese, the Bank of Japan. And that is really, right now the United States, yeah, sure, the Federal Reserve has a balance sheet, but they're buying paper. They're not buying actual stocks. They're not buying actual equities. And according to this, and I believe it's correct, Japan is the first central bank to actually purchase equities. Now, when he says carrying this trade to invest in the equity market, is he referring to foreign equity markets as well? It would not surprise me. I know part of the whole Federal Reserve dollar as a reserve currency setup was so that foreign companies could get paid in dollars for their goods. They'd sell their goods in the US would pay in dollars, and then they would take those dollars and invest in US companies, and everything would kind of go up from there. Well, of course, the problem is that when, dollars are backed by gold, that all makes sense because it's sound money. But when you're printing money out of thin air, that becomes a problem because you see a lot of inflation, and the inflation happens in the US equities market. So if these companies are pumping money into the US equities market, and that money is printed out of thin air, then of course the US equities are going to be inflated, right? And this is how inflation is hidden in the stock market. So let's review that. The deal with Bretton Woods and the reserve currency was such that foreign companies could sell their goods to the US. The US had the strong economy at the time and still has a very strong economy. But so if you're like France and you're selling cheese, and you're Germany, you're selling cars, and whatever your product is, you send it to the United States. The United States sends you dollars. With those dollars, you can fund whatever you need to fund in your own economy, but you can actually invest those dollars into the United States equities market, right? And with that being the case, if those dollars are inflated unnaturally, that means that the value of your equities are also inflated unnaturally. See? So it's a nasty, nasty circle. All right, so, and this is the comment that I make earlier about exporting our inflation around the world. Because if the rest of the world owns an inflated stock market, and that's where a lot of their wealth is stuck, is in an inflated stock market, then their wealth is inflated. And when the US stock market takes a hit, everybody's wealth is going to take a hit. And this is why there's so much interest around the world in keeping the US equities market high, because that's where so many sovereign funds and foreign investment funds keep their money. So, Japan though, let's roll back to Japan, and the fact that they're using their cheap created money for the carry trade, right? So it says here, and this came from Via the Gorilla, by the way, and he sent this to our private group like a couple of months ago. We do a lot of USDJPY analysis and trading, and the USDJPY is, I'll put it up on the chart and I'll overlay it on top of the TLT. So the orange line is the USDJPY. This is the dollar versus the Japanese yen. This is the US dollar in terms of Japanese yen, right? And so you'll see it on the left. This is the price of the US dollar versus the Japanese yen. So when the dollar gets strong or the yen gets weak or both, this orange line goes up high. When the TLT, which is basically it's the 20-year treasury bond ETF, right? This is where people can invest in 20-year treasury bonds, and they have a company that will purchase a whole bunch of those bonds. It's called an exchange traded fund, and then people can own a piece of that company and thereby get exposure to these bonds. And when TLT goes down, you'll notice there's a relatively inverse, not always, but it's a relatively inverse relationship between the USDJPY and the TLT. Because what the JPY is, basically, is they're in QE to infinity. The Japanese yen was really made very weak for many years, and it has been so for many years, and they're using that money to purchase equities, they're using that money to actually trade for the currencies, and so they're just kind of printing all this basically negative yield JPY, and they're using it to purchase what they want to purchase to keep themselves afloat. And they're allowed to do so just because of the way everything's set up. So it's actually called the world's biggest carry trade. And again, this came from Via the Gorilla over at Algo Factory's private group. And he said that BOJ cannot afford a stronger yen because the government of Japan is engaged in a massive $20 trillion carry trade. First, recall that the carry trade involves borrowing in one currency cheaply, Japanese yen, and converting that borrowed money into a foreign currency which offers a superior yield. Excellent papers from the St. Louis Fed, IMF, and Deutsche Bank consolidate the Japanese government's balance sheet to include the central bank, that's the BOJ, Bank of Japan, state-owned banks, namely Postbank, and pension funds, namely the GPIF, the world's biggest pension fund. The Japanese have a lot of money saved up. Their pension funds are massive and they're well funded, probably the most of the world. Because they had a lot of wealth they've created over the last 30 or 40 years. Back to the write-up here. On the liability side, Japan is primarily funded within low-yielding Japanese government bonds, JGBs, and even lower-cost bank reserves. The asset side is mostly loans, like the Fiscal and Investment Loan Fund, which is the FILF, and foreign assets, primarily via Japan's largest pension fund, the GPIF. So that says it right here that the JPY, the Bank of Japan, Japanese in general, are using money to buy foreign assets, primarily via Japan's largest pension fund. Right? And that's where so much of their money is. They have a massive pension fund, and a lot of that and the value of that pension fund is going to be relative to foreign assets. And I'm willing to bet that most of those are in the United States equities market. As the authors of the Fed paper argue, Japan is funding itself very low real rates imposed by the BOJ on domestic depositors while earning higher returns on foreign and domestic assets of much higher duration. As that return gap has been expanding, this has created extra spending flexibility for Japan's government. At a gross balance sheet value of around 505% gross domestic product, or 20 trillion, the Japanese government balance sheet is simply put one giant carry trade, right? Just as Glutton had said in his tweet, call it a tweet, I don't know what you call it, a post, an X post, whatever. Crucially, 1/3 of this funding is now effectively in overnight crash. If the central bank raises the rates, the government will have to start paying money to all the banks, and the carry trade's profitability will quickly start unwinding. Consider what would happen if sustained inflation required the Bank of Japan to hike rates. The liability side of the government balance sheet would take a huge hit via higher interest payments on bank reserves and a decline in the value of JGBs. The asset side will suffer a rise in real rates and an appreciation of the yen that causes losses on net foreign assets and potentially domestic assets too. So that last bit is a bit meaty. Should probably kind of explain that a little bit. When your balance sheet is going to be affected by interest payments on bank reserves, right? So if the interest is actually negative, real negative, negative. I mean, it might be nominally positive, but long story short, the lower the interest, the lower interest payments, and therefore your bank reserves are not going to cost you very much money. That's why it's very cheap for them to fund this, right? The other side of it is the asset side. So there's liabilities and assets, right? Banks have both. Everybody has both. A liability is a financial scenario that goes against you, and your assets are your financial scenarios that help you, right? So a car generally is a liability. Yes, you need a car to go to work and everything, but cars depreciate over time. They're going to be worth less when you sell them unless they're a collector's item, and that's most cars. An asset is going to be something that appreciates, like gold, for example, has been an asset for thousands of years. You hold on to gold long enough, so far, it just keeps going up, right? So the liability side will take a hit because interest payments on these bank reserves for any bank is going to be a liability. But when your rates are super, super low, that's a low liability. Now, the asset side will suffer via rise in real rates and appreciation of the yen that causes losses on net foreign assets, potentially domestic assets too. So the cheap money is enabling the Japanese to buy their foreign assets and potentially domestic assets, although domestic assets are priced in the yen, so that might be a wash. But long story short, the Japanese are ever forced to hike their rates, everything is going to be in trouble. And one of the things that'll be in trouble is their pension fund. That's really ugly. So Japan's going to have a very big interest in keeping those rates very low. And that can cause a big inflationary problem over Japan. And if inflation hits too hard, the only tools that they have to fix it are the same tools that will destroy their economy. But and that's, to take a look at the chart right here, you can see this inverse relationship. As the dollar gets stronger, the TLT goes down, right? And that goes back to this original post here as to why when US bonds get bought, USD gets weaker. Right? So who's buying the bonds? Well, the Bank of Japan is buying them, and that causes the dollar to go down. You're also going to see this inverse relationship is when the TLT goes down, the bonds get weaker and the dollar gets stronger, right? So it's an interesting concept. And of course, the double whammy is when Japan is going to go ahead and weaken their currency so they can buy more bonds and further push the valuation of the bonds down and make the dollar stronger. It's a vicious circle, and it seems like a financial perpetual motion machine, but something's got to give somewhere, and that's usually going to be in price inflation. And it's that whole conundrum we just discussed at length when it comes to the world's biggest carry trade. And that's why the USDJPY is a crucial component of what happens when you play this game of bonds being bought and the dollar getting weaker, right? The Japanese yen is kind of like the pressure relief valve for that whole system. Okay, so we got the UK oil. I just wanted to also show what happens when trouble gets stirred up around the world, what can happen to oil price. Probably the biggest example, and unfortunately, I can't use TLT as an example here because TLT wasn't really being traded back in 2001. But in September of 2001, we had 9/11 happen. And shortly thereafter, in November, December, oil price really started to hike up. So we can see that oil price goes up once you start to have trouble in the world. And of course, the other reason it went up is because the economy started to do really well. A lot of it to do with money printing in the US and house prices going up and the mortgage-backed security issue. And then you have the Great Financial Crisis, right? So the Great Financial Crisis happens, oil takes a tumble because everything takes a tumble, and TLT goes up, right? So bond values go up. Interesting thing, right? So if the value bonds goes up, the dollar gets weaker, and yet in this scenario, things got so trashed because oil got weaker and dollars got weaker. More dollars chasing oil, and yet oil still fell. So this is what happens when the whole supposedly perpetual motion machine stops working. You get 2008 to 2012, and really 2009 for 2012 for the rest of the world. We're not really looking at the market itself. Now, they were able to push the oil prices back to normal around, say, 2008. And then we also have to remember that value of the dollar is going to be relative to the value of oil, right? So if oil price goes up, then more bonds are going to get bought to purchase, more dollars are going to get used to purchase the oil, right? And then, of course, you have central banks that are going to go ahead and buy the U.S. debt to crush the dollar value down. It just becomes another nasty circular problem. But let's look at what happens when we see trouble getting stirred up, right? In 2020, we had the COVID crash, and oil went ahead and tanked, and you can see the TLT went up, right? So this is the value of those bonds. So as oil crashed and TLT went up, that means that the yields went down and the dollar got weak. And then as the dollar got super weak, oil and actually the rest of the stock market really started to hike up. And that happened when a bunch of money was printed. So dollars got weak and a bunch of money was printed, right? And actually that's all in one big package. Dollars started to get weak, quite possibly because a bunch of money was being printed, but it's also beyond that. So now here's another place where trouble got stirred up and oil price really made a big move. And this was in, and I don't know that this was the US stirring up trouble. I think, look, the Russian situation, the SMO or the invasion, whatever you want to call it, there are a lot of theorists to say that started because of what happened in 2014 in Ukraine, which actually was caused, according to these theorists, by certain assets of the West, aka, maybe some that have to do with the United States, three-letter agencies, Maidan coup, this whole thing. Well, it culminated in what happened in 2022, and eventually the trouble got stirred up, and you can see what happened to oil right here, because Russia is a massive oil-producing nation, and natural gas goes through Ukraine, and that also got interrupted, and you saw this hike up really high, and so the price of oil went up really high, and when the price of oil went up high, of course, the United States is a massive oil exporter as well. I think it's the single largest oil exporter in the world. I know that a lot of other countries can cobble together and say that they're bigger than the US, but I think the US actually exports more oil country. At least that was as of last year or the year before. So oil price goes up, right? And we then have countries that need cheap oil, so they're going to go ahead and load up on US debt. And then they're going to use dollars to buy oil, and it just goes all the way back around and round and round to the same issue of US bonds get bought because foreign central banks need cheap oil, right? Oil's priced in dollars, US bonds are bought, USD gets weaker. US needs its bonds bought. US stirs up trouble to cause oil to explode higher. So when bonds get bought, which needs to happen, it weakens the dollar. So in order to strengthen the dollar, US supposedly, according to this theory, stirs up trouble to cause oil to explode higher, which is going to push up the demand for dollars to buy that oil. So it's almost like the more that bonds get bought around the world, the more the United States needs oil to go up. And by this theory says the US stirs up trouble. Is that still working anymore? Is it still working? Well, we can take a look at a modern example back on this chart. And there was some trouble that happened in Israel recently, October 7th. We all know there was this music festival, and it kicked off the Gaza war and all that. And here's the problem. Oil price went down from there. Now, if you look at this tweet and go further, there are some comments that it's being held down by the paper game, but the real market is going to catch up. Well, on top of that, kind of impressed that they're able to hold it down, because if you take a look at the real scenario in the Middle East with oil exporting and being moved through the Red Sea, the Houthis are actually essentially blockading oil, right? So a lot of, say, British, US related type ships can't get their oil very easily out of the Red Sea. They can't get through the Suez, and they can't get it out of the Red Sea. So that should be limiting the supply of oil around the world, and yet we see oil falling. So one of two things can be happening. A lot more oil is being quietly produced by other countries to keep this from being, keep demand from going up, or we have the paper game that's holding it down, and the paper game can't last forever. And what I mean by the paper game is where people are using contracts and futures and financial machinations to hold the oil price down. But it does seem that they're actually holding this pretty well, because this happened in October, and we're now in January, and oil has only gone down. I expect oil to go up, and if you look at my video from last week about the Houthis and the US airstrike on the Houthis in Yemen, I do expect oil to go ahead and reapproach $100 and maybe even $120, and oilprice.com has a lot of data on that as well. And again, just go back to my video from a couple of weeks ago, and I'll go ahead, I will actually make that video the video that pops up at the end, so you can click that thumbnail and see it. So I know this is kind of a complex and long discussion, but I wanted to use these charts to describe what's going on, and I think that this gentleman, or whatever here, Expound the Profound, has a decent theory. I think it's at least part of the equation, and it might be more than part. It might be the largest part, but it's at least a part. I can wear that tin foil and be like, yeah, no problem. All right, thank you for sticking around, listening to my stuff. I hope this made sense to you. Please like, subscribe, hit the notification bell if you're on YouTube. If you're following on X, please follow and like, and we'll see you in the next one. And come over to Algo Factory. Remember to trade your job, upgrade your life. Catch you on the next one. All right, hope you enjoyed the show. Please like, subscribe, hit that notification bell. On the screen there, you can see our website, algofactory.tech. Step that QR code to take you straight there. I'm also very active on X. That's algo_factory777. We got TikTok and Rumble. In the meantime, we hope to see you over at the website. Come on over, trade your job, upgrade your life. We'll see you there.